A single report out of Shanghai erased billions from ASML's market cap in hours, claiming a state-backed Chinese consortium had begun mass-producing the lithography machines only one company on Earth was supposed to build. Does the threat match the panic? The report published by The Information on July 27, 2026, citing people familiar with the matter, outlined a concrete industrial event in Shanghai. A state-backed entity had transitioned from laboratory prototyping to the mass production of domestic immersion deep ultraviolet lithography machines. Operating as Shanghai Aishengna Electronic Technology Group, this enterprise pooled development teams from several domestic firms, including Shanghai Yuliangsheng Technology and SMEE, consolidating patents on immersion optics in high precision stages. The machines themselves use a 193 nanometer light source and a precise water-assisted optical layer to print microscopic circuits onto silicon wafers. Rather than a limited research experiment, this is a commercial manufacturing push aimed at direct deployment in active clean rooms. The consortium has already secured commitments from its first planned customers, Semiconductor Manufacturing International Corporation, Hua Hong Semiconductor, and Changshin Memory Technologies, which will install these domestic tools directly into their fabrication lines. The reaction on global stock exchanges was immediate and severe. On July 27, 2026, ASML shares plunged as much as 8%, sinking to their lowest level since early June. In a single trading session, the slide erased approximately 55 billion euros in market capitalization. The panic quickly spread across the Pacific, dragging down American equipment giants Applied Materials and Lam Research. This was not a random sell-off, it was a cold calculation of revenue exposure. By 2026, sales to China were projected to account for roughly 20% of ASML's total revenue, down from 33% the previous year. With high-end extreme ultraviolet systems already blocked by export controls, deep ultraviolet sales to Chinese fabs represented ASML's last major revenue pipeline in the region. The sudden threat of a domestic substitute hit investors where they felt it most. Export controls in late 2023 severed ASML's ability to ship its premier extreme ultraviolet systems to Chinese buyers. This restriction concentrated China's purchasing power into a single remaining corridor, deep ultraviolet immersion lithography, the fundamental workaround for mainland foundries. As a result, China became ASML's most concentrated market for mature node equipment, representing nearly 30% of total system sales in 2025. This narrow exposure meant any viable domestic alternative would directly jeopardize a massive revenue pipeline. Alongside local technical rivalry, political action in Washington presents an independent threat. The proposed Match Act, introduced in April 2026, aims to mandate a strict embargo on deep ultraviolet servicing and hardware sales to blacklisted Chinese entities, meaning ASML's primary remaining revenue engine in the region could be dismantled by legislation alone. The immediate industrial reality reveals a massive scale disparity. The Shanghai consortium plans to deliver 5 immersion machines in 2026, scaling to 20 in 2027. By comparison, ASML projects shipping 130 immersion systems in 2026 alone, with a 30% capacity increase scheduled for 2027. Beyond raw volume, the technical gap remains vast. The Chinese systems represent a multi-generational lag, matching ASML's 2008-era specifications. Research firm Semi-Analysis emphasizes that serial production at scale is the most underestimated barrier. Before these machines can run in high-volume fabrication plants, they face a grueling qualification phase. To run commercially, any new scanner must achieve at least 85% uptime and stable yields over tens of thousands of test wafers. Until these domestic tools prove their precision and overlay accuracy, throughput, and defect density, ASML's operational dominance is secure. ASML's decades-long lithography dominance faces a structural test. While immediate hardware parity remains years away, Even a minor Chinese foothold threatens long-term pricing power and global sourcing strategies. Two distinct pathways now emerge. In the first scenario, the domestic system struggled with yield and reliability through 2027, leaving ASML's commercial dominance intact. In the second, successful scaling by 2028 triggers a slow, permanent erosion of deep ultraviolet revenues. However, the most critical short-term driver remains regulatory rather than competitive. Analysts are tracking Washington and The Hague for pending export control enforcement, alongside delivery metrics and validation reports from SMIC, Huahong, and Changshin Memory. Ultimately, legislative restrictions on servicing existing tools present a far more immediate threat to current revenues than the gradual climb of domestic Chinese manufacturing. ASML's true risk isn't immediate displacement, but a permanently fractured global market. While headlines spark panic, scaling yields remains the ultimate battlefield. Share your thoughts below.